Hello. In this video, I'll be going over equity investments using the equity method, and we will split the videos into two separate ones so it's not too lengthy. Let's quickly go over accounting for equity investments. And equity investments are when a corporation buys stock, whether it's common stock or preferred stock in another company. And the way we account for it is we have to record the actual purchase of the investment of the stock. And if we receive dividends, there's going to be an entry for that. And depending on the type of investment, the changes in any fair value may be accounted for differently. And then when we sell the investment, we have to record that. We've previously gone over the different categories for equity investment. There's the first category is when an investor does not have significant influence over the operating and financial policies of the investee, which typically means they own less than 20%. And in that situation, we use the fair value method to account for that investment. That is in a different video. This video will be focused on when an investor does have significant influence over the operating and financial policies of the company they invested in, and that typically means that they own between 20 and 50% of the voting stock. In that situation, we use the equity method to account for that investment, and we'll go into that in this recording. When a company owns more than 50% of the voting stock of another company, it's considered to have control of such company. In that situation, the financial statements would need to be consolidated. This is covered in advanced accounting. So let's talk about when an investor has significant influence using the equity method. So we talked about control is when they have more than 50%. Significant influence is usually assumed when investor owns between 20 to 50% of the investee's voting shares. This is very important. It has to be voting shares. So what does significant influence mean? Because this is what we're going to focus on right here. It means that the company that invested in another company can sway decisions in one way or another in their favor. And in that situation, when a company has significant influence over another company, the investment is accounted for by using the equity method. When we use the equity method, the investment is initially recorded at the cost, and then the investment balance on the balance sheet is adjusted for the net income or net loss and any dividends paid for from that investment and other items potentially. Let's go through an example because that will be the easiest way to see how this the accounting works. We have a company where we acquired Argent. I think this is from previous examples where United made an investment in Argent Inc. by purchasing voting stock on January 2nd, 2027 is when they purchased it. And the fair value of Argent on that date is $5 million. And we will assume that United purchased 30% of their stock. So therefore, we need to account for it using the equity method. So the first thing we're going to do is we're going to debit the investment at 30% of their fair value, which is 5 million times 30% is $1.5 million, and then we credit cash 1.5. So, and this is our balance sheet asset account, the investment. Next, because this is an equity method, we will report our portion that we own of the company. We will report that portion of any earnings that company has made and any dividends that company has declared and paid. So in this situation, in this example, Argent's 2020, we're going to fast forward to the end of the year. and Argent's 2027 net income was $500,000. Well, we've said that we own 30%. We bought 30% of Argent's stock. So we're going to take the 500,000 times 30% equals 150,000, and we're going to increase our investment by that amount, the 150,000. We're going to debit investment equity affiliate. That's our asset on our balance sheet. And then we're going to increase our investment revenue by that amount, and that goes on our income statement. When we receive dividends, right, because we own stock in this company, if and when they declare and pay dividends, we as an investor are going to receive them. We're also going to, so 30% of that dividend is going to be paid out to us. So if in 2027 Argent declared and paid $250,000 of dividends, we're going to receive 75,000 of that, right here, because it's the 250 times 30%. And we receive that cash. So we're going to debit cash 75,000. And notice here we're going to credit investment in equity affiliate. So you might be asking, why are we crediting our investment, thereby reducing our investment, rather than crediting dividend revenue? Well, the answer to that is because when we recorded our proportionate share of the net income, right, in the prior slide, we credited investment revenue for that portion. And a part of the net income, that is the way we get a dividend, is the current year earnings or prior year earnings are being paid out. So if we were to credit this as dividend revenue, it would essentially be double counting revenue for the same money. So the rationale really, instead, we view the dividend distribution as reducing Argent, that's the company we're investing in. It's reducing their net asset, and basically Argent is returning those assets back to the investor when they pay a dividend, and in the form of a cash payment. So therefore, our equity should be reduced because Argent is basically paying us back part of our investment. Let's do a concept check. The equity method recognizes investment revenue when dividends are paid by the investee. No, it does not. When dividends are paid, it reduces the investment account. So that's not correct. B, the equity method increases the investee's net assets when a dividend distribution is received. That's not true. When a dividend is received, it actually reduces the investee's net assets. It reduces their net assets. And the investee is the company that we are investing in. And reduces their net assets because they're actually giving back some of our investment to some of the investment back to its shareholders. The equity method views the dividend payment as returning assets to its investors in the form of a cash payment. Well, we just talked about that, and that is exactly what a dividend payment does, and that is the correct answer.